All right, let's dive into a classic deep value investment case study. We're going to rewind the clock all the way back to 1950 and look at one of the very first big bets made by, get this, a 20-year-old student named Warren Buffett. This thing is a perfect blueprint for how you can spot an incredibly cheap stock. You know, this quote from a pretty well-respected investor back then, it just says it all, doesn't it? I mean, to the old guard on Wall Street, Buffett was, well, he was just some kid. But what they didn't know was that this kid was about to plow almost a quarter of his entire net worth into one single overlooked company. Talk about conviction. And that right there is the big question we're going to tackle. See, this wasn't some tiny, unknown company hiding in a corner. Marshall Wells was a major player, a Fortune 500 company. So how in the world was it trading so cheap that a grad student could just waltz in and spot this massive opportunity? All right, let's dig in and find out. Oh, and hey, before we really get into the weeds here, if you're interested in finding cheap stocks that can help you beat the market, check out MrDeepValue.com. All right, so first things first, let's get a handle on the business itself. Because, on the surface, Marshall Wells seemed pretty ordinary, kind of boring even. But when you peeled back that first layer, man, it was an absolute giant in its industry. Okay, just take a look at the sheer scale of this operation. It's kind of nuts. I mean, we are talking about the largest hardware wholesaler in all of North America. This company was so big, it landed on the Fortune 500 list. And this proves a really important point for all of us. Deep value bargains aren't always hiding in some dark, obscure corner of the market. Sometimes they're hiding in plain sight, even with huge established companies. And the business model? Super straightforward. They were basically the essential middleman. So they'd buy all the stuff, tools, paint, you name it, from hundreds of different manufacturers, and then they'd turn around and sell it to thousands of small, independent hardware stores. They were a totally critical link in that whole value chain. So that's the business. Now, let's get to the juicy part, the incredible value that the market was just completely ignoring. Because the real story here, the real magic, it wasn't in what the company did, but what was hiding deep inside its financial statements. Okay, so here's the number to lock in your brain. $200. That's the price Buffett paid per share back in 1950. Keep that $200 front and center because everything we're about to break down hinges on that purchase price. Okay, now check this out. At the time, the market was valuing the entire company, the whole shebang, at just $11.4 million. But get this, its tangible book value, and that's just the hard physical stuff you can touch, the assets, was over $33 million. That's almost 3 times higher. I mean, that is a massive, glaring gap that you could drive a truck through. And it gets even crazier when you look at it from an earnings perspective. The company's enterprise value was only $7 million, but it was cranking out over $3.6 million in operating profit. That's EBITDA. So that gives you an EV to EBITDA multiple of, wait for it, less than 2. To put that in simple terms, you could have bought the entire business and it would have paid you back in operating profits in less than 2 years. That is just unbelievably cheap. So let's dig a little deeper into those assets, because this is where you really see why it was such a safe bet. Over 80% of them were current assets. We're talking about things that can be converted into cash pretty quickly. And the biggest chunk of that was inventory. But this wasn't like, rotting fruit. This was hardware. Tools, farm equipment, stuff that holds its value really, really well. We're talking about a rock-solid asset base here. All right, and this is the real kicker. This is the ultimate aha moment of the whole story. The net current asset value, so that's your liquid assets like cash and inventory, after you subtract all the debts and liabilities, it worked out to $331 per share. And remember what Buffett paid? $200. He was literally buying the business for 60 cents on the dollar. And on top of that, he was getting all the warehouses, the trucks, the entire operating business for free. That, my friends, is the definition of a margin of safety. Now, of course, no investment is perfect, right? There were definitely some real risks here. The whole post-war economic boom was starting to cool off, competition was getting tougher, and it was a closely held company, meaning minority shareholders didn't have a lot of say. But let's be real. When you can buy a business for a 40% discount to just its liquid assets, you are being more than compensated for taking on those risks. So, you've got this incredible slam dunk bargain. You'd think Buffett held on for years and made it killing, right? Well, this is where the story takes a really surprising turn.
Yeah, he didn't hold it for long at all. In fact, he bought the shares and then sold his entire position within the very same year, 1950. And get this, he actually took a tiny 1% loss. So what on earth happened?
Well, it all came down to the people running the company. See, Buffett actually went to the annual meeting, and he was, let's just say, completely unimpressed. He saw a management team that just seemed lazy, disinterested, and frankly, didn't seem to care about its owners. And for him, even as a 20-year-old, the amazing numbers just weren't enough. The qualitative stuff, the people, mattered just as much.
Okay, so Buffett cashed out and moved on. But what happened to Marshall Wells? Did that deep value that was so obvious in the numbers ever actually get unlocked for the people who stuck around? The answer is a big, resounding yes.
Just a few years down the road in 1955, an activist investor swooped in and bought a controlling stake for $375 a share. And as the business started to face some challenges, the new owners did exactly what the numbers had been screaming to do all along. They started selling off parts of the company, unlocking all that hidden value piece by piece. It totally proved that Buffett's initial math was spot on.
And for any investor who bought in right alongside Buffett and just held on until that buyout in 1955, well, their patience would have paid off big time, to the tune of a fantastic 15 to 18% annualized return. The deep value thesis played out absolutely perfectly.
So look, this is an awesome story from the past, but the real question is, how can we use these lessons to find similar bargains today? Let's break it down into a simple, actionable guide. Think of this as your 3-step deep value checklist. First, you gotta screen for companies trading at ridiculously low earnings multiples, just like that EV to EBIT of under 2 that we saw with Marshall Wells. Second, you've got to find a deep discount to the hard assets, and specifically, look for that net current asset value, the NCAV. And third, you have to confirm that the discount is big enough to give you a real margin of safety against whatever business risks might be out there.
So what does the profile of a modern-day Marshall Wells look like? Well, it's a company that's trading for less than its net current asset value. It's got a proven history of being consistently profitable. And it probably operates in a boring, overlooked industry that nobody on Wall Street is talking about. And finally, it's backed by solid, hard assets that aren't going to become worthless overnight.
And that really leaves us with the most important takeaway here. The exact same principles that worked for Buffett over 70 years ago, they are just as valid today. The real question for all of us is, which overlooked, profitable, asset-rich companies is the market ignoring right now?
That's it for this one. Thanks so much for tuning in, and we'll catch you in the next case study. And hey, don't forget, you can find cheap stocks to beat the market at MrDeepValue.com.